ladies and gentlemen. We will now proceed to the final event of the day, which will be the panel discussion. We will be looking at hot topics of the moment, things like protectionism, the growing influence of populism in politics and decision-making, the impact that is having in the way financial assets behave, and also we will look at specific aspects of instruments like gold and the pound, etc., things that may be of interest to the public. So without further delay, I would invite the other members of the panel, so Gavin, Andrew, Luke and Zach, to join me on stage, and we will have a chat, and hopefully it will be interesting. I'm looking forward to it. Okay, well, whoa, that's a bit loud. So I would kickstart this panel conversation by talking about protectionism. And I would ask Gavin, starting from the left, in your view, Gavin, is protectionism the result of a populist uprising against growing inequality? And is that having quite an impact in the financial markets?
Yes. And because we've got limited time, there's a super book that I'm going to point you to that I've just read. It's The People versus Democracy. And it's by Yash Monk, spelled M-O-U-N-K. You'll get everything you need to know in that book. It talks about, now, many of you will be aware, or may not be aware, that I lived in Chicago, as I mentioned earlier, for many years. So I'm still in touch with many of my friends who are traders on the floor of the exchanges, both New York and at the CME. And this was a statement from the book, just one of the statements that I thought I'd pick out for this panel. Citizens have built up loyalty to their political system because it kept the peace and swelled their pocketbooks. No more. We have seen the Great Depression coming a second time. Markets move in cycles, and Tom Williams taught me this. He believed very much in the Fibonacci cycle, the 7-year cycle. I believe in that too. We look at the market crash in 2009, 2010. As I showed you, that was the market bottom. It was the bullish behavior of professionals who could see that stocks were of great value at this point. And what we've seen is massive unrest in many different countries. It's not just the US that's protection. Remember, this China trade war that's going on right now, it's interesting to note that Trump just reneged with Canada. He's basically said, look, we're going to have no more fines for you. So there's a system underlying here that's at play. Now, I'm a trader. I'm not an economist. So I'm looking for opportunities to make money. That's all I'm interested in for my fund and people around me who work with me. This market at the moment is the best bull market I have ever seen. And Tom Williams, I know back in 2014, and we had this Ebola crisis, and he said, Gav, this is going to be the best opportunity to buy. And he was right. Because we saw on that chart of where the market was marked down on Ebola, that's exactly what happened. So I believe, to be clear, there's some very big opportunities here. I think gold's going to become weak. I think cryptocurrencies are going to pick up. And I believe we might see another correction in the stock market before we see a big rally.
So do you directly link this long-running bull market that we've had for the last 10 years, do you link that to some extent with the very dovish policies from the main central banks, and then how that repercuted in the way the financial markets performed? Okay, that's a good point. I do agree with you. There is another side of the coin to that, though, in my view at least, which is that it's been good for the market, so it's been good for Wall Street, but it hasn't been perhaps as good for Main Street. And we've seen that wage growth stagnated. The growth in many of the main global economies has been very weak. And to some extent, we could perhaps trace the origin of this current populist, protectionist global movement to that. What's your view on that, Andrew?
Well, that's quite interesting. I do agree. I think, firstly, central bank monetary policy has led to record highs in the exchanges and the indices. Completely true. But I think, in terms of, was 2008 that moment? Was the poverty we are seeing and the inequality levels we're seeing, are they causing the protectionist policies? I think realistically, no, would be my opinion, because I think economies grow, they change, they evolve. The Deputy Governor of the Bank of England came out and called the British economy menopausal about a month ago, and got into a lot of trouble for it. I think what I would say is what he really meant was that we are moving from one state to another state, and we're experiencing the weird bit in the middle. We saw it last time round, we saw it in the Industrial Revolution, we saw it at the beginning of the Technological Revolution, and we're seeing it again now, where productivity levels are very, very high, where employment is very, very high, but we're not seeing people on the ground getting richer because we haven't got the next thing. We haven't moved to the next stage. When they invented the plough, everybody said that what would that do to farming? Lots of people lost their jobs, but what they ended up doing was driving tractors. It's the same thing every step of the way, and artificial intelligence, modernizing everything from computing to cars to industry. There is always going to be a period where the normal person on the ground is worse off. And in economics, we call that the lost generation effect. And that's exactly what we're seeing.
Well, it's good to hear an optimistic view. What's your view on this, Zach?
Is this working? Yeah. I think I agree with what the speakers have said and what you've said so far, but there's certain angles which don't quite tie up the issue whether we're in the slow growth issue. I don't think that's a problem. I think we're in a Goldilocks situation. We've got ultra low interest rates which haven't led to inflation. We've got markets which are essentially a buy on dips. We've managed to, in the last 10 years, see China and India and developing countries come through, and I think that's the reason for the populist or the trade wars, because 20 years ago China wasn't producing enough to warrant a problem with America. Now it's so big they actually just have to renegotiate the way they work together. So I don't think it's portrayed as a very as a war, but I think it's really just a renegotiation because of changed the relationship between developed countries and developing countries. The populist thing, I think, hasn't actually really had a chance to have a voice. Brexit was populist. That's been smothered. Trump has been, despite all the bluster, very contained. And I don't think he's really been able to he hasn't been able to build his wall. There are a lot of things he hasn't really been able to do, and he hasn't actually had a win yet in terms of any of his policies. The only thing we know is that he wants the stock market to go up because he sees that as a badge of honor. And that's the only thing that he's been really, let's say, successful in pushing for. But then that was the Fed's policy anyway. That is, the Fed put is there for us. And let's say on Monday there's an announcement that Chinese are walking away from the trade wars, the Dow goes down 1,000 points. You know that's a time to buy because you know that that's what the authorities want. In the UK we have the housing market, which is again a buy on any dip. It's controlled. The government wants it to go up so it can tax it. So I think in general it's amazing that we've got away with having near zero interest rates and relative balance and relative harmony in the way things are working, even though the media likes to say this populist this and populist that.
Yeah, it's interesting. It's interesting because despite having such low interest rates for such a prolonged period of time, that has not affected inflation. So it's a bit of a conundrum there.
The only point that I think nobody has mentioned was debt, because debt levels now are much higher than they were in 2008. And you've got things like in the UK, you've got things like Metro Bank, which is effectively bust, I would have thought. Thomas Cook, which is bust. A lot of companies out there holding a lot of debt, or going to go down, but somehow the system manages to absorb them, which is a weird thing to happen. Thomas Cook normally, before you would just be amazed at how you could have £1.5 billion of debt in a travel company. And there's the AA, there's all the hedge funds are going short of these. There's quite a big, a lot of names where the hedge funds go short. Very easy shorts as well. But the level of debt, I don't think anybody really knows what's going to happen there. Whether there's going to be at some point the house of cards will just collapse again, and that will be the systemic blow for the market.
If I can cut in here, Zach, as an economist, my immediate thought is basically it's called the theory of creative destruction. I mean, you would be looking, if something like Thomas Cook goes, or something like Metro Bank goes, there is an impact on the market. But long term, if we're talking about equality and inequalities and the rise of populism, actually those things dying off is a good thing. Because what it does is move the skilled people from that business into a new business. And if you don't do that, for example, Japan, and one of the reasons Japan's economy has struggled is because the Japanese government will step into big companies and hold them up. Not just banks, but actually companies as well. And as a result of that, we're not getting the talent, we're not giving the talent the opportunity to do something different and try something new.
That's a very interesting point, Andrew. I do agree with you. Sometimes the intervention of governments and central banks can be a good short-term remedy to a complicated problem, but in the medium to long term may actually have a negative effect. Look, on that note, looking at the negative effect in the medium to long term of an event that wasn't managed to perfection, what is your view on the financial crisis and the recession of 2007, 2008? Do you think that we can trace some of the problems we have today to that moment, and why?
Wow, what a question. First of all, trading back in those times gave us some great insights to how the markets were behaving, not only in terms of how extended they were, but I remember having conversations post the event. I wasn't trading back in 2008. I'd only really just left school, so...
Lucky you.
But hey, it gave us some great insights. Now, leading up to the event, we now know, because of the way that it played out, from a technical perspective, and I do have to talk from a technical perspective, being a trader, that once we start to see that price action come through, it's amazing how quickly you can start to identify when a market is overextended. And you can relate this back to many, many different markets now, i.e. we saw when cryptos were coming in and everybody was buying into cryptos, we saw the exact same ending pattern come through in cryptos that we saw in 2008 when the bust come through. So and I do have to keep this technical because I've got an economist sitting next to me and don't want to say anything that's going to upset the economist. But it gave us a great insight from a technical perspective about how an ending pattern comes through and what we can be expecting to see when a big crash is coming. And where the markets currently are, I think they're in a relatively healthy position. I don't think we're in anywhere near as much trouble as we were, but we could certainly see another correction come through. So I think there's some very valuable lessons that we've learned from that experience.
Okay, so you agree that to some extent the changes and the dynamics that we have in place today, this Goldilocks, I mean, I don't like using this word, but I suppose I have to agree with Zach. It's been Goldilocks. It's been Goldilocks for Wall Street, but perhaps not for Main Street. But okay, I do get your point. Things on Main Street, though, have been much more complicated and less shiny. And we have the new revolution just around the corner. We have AI, Gavin, artificial intelligence. In your view, do you think this is likely to... We know it will impact the financial markets because people will eventually start trading in a different way, and organizations and the markets will change once this is at full speed, this revolution. But do you think that it will also have an impact on the markets via the social channel? So the way artificial intelligence will impact the way people live and work, will that also have an impact on the markets, and how?
Well, again, I'm going to recommend another book here. How many of you here have heard of high-frequency trading, HFT? Put your hands up. Okay. So, artificial intelligence is already in the markets to some extent anyway. Now, there's a great book, again, that I've read several times, Michael Lewis, Flash Boys. Have you heard of that book?
Yes, of course.
Very good book. Now, in it, Michael discusses the Bank of Canada, and one of the traders, the head trader there at the Bank of Canada, who kept seeing his orders being beaten by milliseconds. Now, when I lived in Chicago, I saw some very big cabling this is in 2007, going into the exchange, or not into the exchange, next to the exchange. And these boxes cost millions, billions in fact, when they were laying these cables. And if you read the book, if you don't believe that, you read the book, it's in there. But what is artificial intelligence? It's all around us already. We've got so many things. And is it going to impact the financial markets? It's doing it already. With high-frequency trading, you're seeing a benefit, if you're a chart reader like myself, because we see the volume. When they move the market, when they attack a price, when they manipulate price, which is what it is, they leave a footprint. So artificial intelligence is not a bad thing. Okay, people are very negative about it. We are, as human beings, as a species, developing things to improve our lives, just like we did after the Great Depression in the 1930s, the Industrial Revolution. All the things happened. Just look at, I saw an interview with the great Steve Jobs back in 1998 it was, and he was talking about the future. And he'd just been fired, I think, from Apple just before that. And he'd started a new firm, and it was Pixar. And he said, there'll come a time when you'll be able to have a handheld device that connects to the internet and you'll get all your information. He was a visionary, because I get all my trade alerts on a phone now. You can actually trade right from your app, Ricardo, from the phone. Now think about that. You can be sitting on a train, if you've got a signal on Southwest Rails, which they do, and you want to take that risk, which I don't, you can actually trade. So my view of it is it's a good thing. I don't think it's a negative thing. Some of it's already here. Read Flash Boys by Michael Lewis. You'll understand what high frequency trading is all about. But understand, HFT, even if it's going through an exchange, will still leave a volume footprint. And they're all, the smart money that I write about in my book, they're all competing against each other. They're not all buddies who ring each other up and say, let's attack gold, let's attack silver. It doesn't work that way. There's groups and institutions fighting a battle. That's what the market is. When Tom Williams was teaching me, he said, Gavin, it's a battle, and every day you have to prepare for the war, and you get up, you prepare yourself, you trade what you see, and don't have too much of a long-term opinion. Let the chart be your guide. And finally, I would say, when you read Flash Boys, look at the amount of money that's being spent by these hedge funds to gain an edge, because that's all you want in these markets, an edge. And that is, I work with the Gibraltar Stock Exchange, and their head trader, Jawad, very nice guy, said to me, Gavin, the only thing I learned, he was one of the biggest traders in the world on the Eurex exchange, and he said, Gav, only thing we need is the edge, and then we can make it.
Michael Lewis, who of course also wrote The Big Short and Moneyball, so a man with a 360 view on the markets. Zach, what is your view on this? Do you think that artificial intelligence will change the way we live? Will it affect people's ability to get a job? And is that likely to impact the markets or not?
I think at the moment it's, for me, too much of a buzzword, and with all these new technologies, they take much longer to come through. I mean, mobile internet took a long, let's say 10 years longer to really revolutionize the way things work. Social media, the effects of that have also been, I think it's coming to a head now with the issues like, the reality TV and the way social media reacts with that. But we've got these, you get these new things and you don't actually know how they're going to affect. I mean, even the crypto situation, we don't know how that's going to pan out yet, and it's been quite a few years. So I think it's nice to get in on the buzzwords of the moment, and it's quite good if there's a small cap in the stock market which has, calls itself, artificial intelligence PLC, and you try and get a multi-bag out of that. But at the moment, I think it's too early to say. I think that, going back to the larger questions, a lot of things that we've seen, for instance, the death of the high street is a result of, smartphones, and it's a result of transparency and pricing. Artificial intelligence will probably make that even greater, in the sense that you'll have it trying to anticipate what people are going to buy, when they're going to buy it, and maybe that's the consequence, that the high street becomes even more in pain than it is now. So the law of unintended consequences is amazing, and it's amazing sometimes where it's affected the high street just from an app on your phone, which would not have been anticipated even like 10 or 12 years ago. And it's amazing that you've got, let's say, the housing market has rocketed, and people are not up in arms. I mean, they're not actually they're quite cool about it. So there's some things which people complain about, and some things which people don't. And I think artificial intelligence will have a great effect on the financial area, our area. But at this stage, I think it's too early to know. And also, if it had too great an effect, then presumably the regulators would come in as well to dampen it down, in the same way that they started doing that with crypto. Crypto, really, for me, should replace all fiat currency. I mean, a decentralized currency, I think, is the way of the future. But obviously, central banks and governments are not going to let that happen. If artificial intelligence takes us down a route which means that the people are cleverer than government for some reason, I think that will also be clamped down. So I think it's just too early.
So the singularity is not near yet in terms of artificial intelligence. Thank you for that, Zach. You mentioned cryptos and how what sort of role that may play in the future. I was going to ask Andrew, what's your view on cryptos? Do you believe in cryptos, and what future do you see for cryptocurrencies?
I love that. Right. Firstly, cryptos in their current form have no innate value whatsoever. And every time in history we have ever seen anything with no innate value that doesn't have a perceivable or what we would call actionable value, like a fiat currency, like the pound, because technically the pound has no real value. Every time we have seen a commodity behave like that, it has led to a massive bust. I think we will see the rise of cryptocurrencies, and I think in the short term, cryptocurrencies in their current form, and when I say that, I'm talking as an economist of 5, 10, 20 years, we'll see cryptos become a big part of the way we shop, the way we do just about anything. But at the same time, they will reach a tipping point. But unlike Zach, I'd be of the opinion that I think the central banks will adopt them. Because if something evolves far enough, the central bank has a choice to let something usurp it or to adapt. And I'm a big believer, having worked with central banks, that they will adapt. Because actually, a crypto version of the pound would be an incredibly secure, you couldn't fraudulently copy it. And also, it would be widely accepted everywhere, and currency exchanges specifically would become an entirely different process. So it would open up the world much, much quicker. Effectively, you could have a credit card with a super currency in, so a floating currency, and then effectively take that and be in the US, click, it charges you there. Click, it charges you somewhere else. but with no exchange fees. It's all just one giant currency because it's all done with the blockchain technology underneath. And that's what I'd round up on, is I think central banks will adopt crypto because they are already adopting blockchain en masse. Talking back to artificial intelligence, some of the kit we're using at the moment isn't quite artificial intelligence. We've got a while to go before institutions really start being able to harness that. But our risk portfolios are built off a calculating algorithmic system, so our risk and sentiment calendars, so our economics calendars, they're all built together to play together and to produce actionable insight. But it wouldn't take much to then introduce a neural network to that, and that's actually what the House of Trading is doing right now. We're trying to work with neural networks to do exactly that, so that we can create effectively a super indicator. If we're doing that, and we're relatively small, you know the central banks are doing it, and you know that the brokers and the banks are doing it. Although Zach is right, 20, 30, 40 years, it's going to be a long time until it's there. But what I would round up on is the idea that cryptos make a lot of sense. Blockchain makes even more sense. And I think it will be blockchain that drives crypto in terms of the central banks adopting it and it becoming something that we just use. I mean, I think the biggest thing for crypto in its favor, though, is I'm sure everybody's got a credit card. How many of you tap every day? How many of you spend money tapping? 10 years ago, the Bank of England didn't even think that was possible. And now they're having to reduce the amount of money they print because nobody's using it. So the moment you get rid of the need for actual money, crypto becomes a real serious option. But again, we're probably 10 years away from complete adoption of that.
Okay, so big future for blockchain, cryptos, at least the ones that are popular today, maybe not. Interesting statements you made there as well. You said the pound has no intrinsic value. That's true. I looked yesterday, it was trading at about $1.2709, something like that. Luke, do you trade pound?
Yes.
You trade cable?
Yes.
So where do you think the pound is going to go? What's going to happen? And what will drive it? Will it be data? Will it be politics, Brexit?
It's going to be a combination, but it all comes down to one core aspect. From the information that I get fed from our economists, from our analysts, you know, the word Brexit is just made up. It's made up for a situation that the UK currently is in. From my perspective, it's where money's moving from and to, i.e., it all comes back down to that singularity of trade. That's all it comes down to. There is not another factor in that apart from the relationship of how we move products from A to B and B to A. So the political side of things is going to be heavy in the short term, but in the long term, realistically, the central banks are going to reposition themselves and have the currency exactly seeing where they want to. And it's about listening to the information that is drip-fed, is fed to us, and getting the economics and our analysts to put that into one coherent thought for where that market really wants to sit. Like we saw today with the pound, it's the 145 area.
So you see cable trading at 145 as its real value, and the price at the moment?
Currently and prehistorically, yes, okay. But it depends on, once we've got the trade deal, where does the central bank where does the BOC want that currency to be sitting? And it is our job just to read exactly what's going on in the market.
The BOE.
We're not Canadian, everybody. Sorry.
This question is too important to get only one view. So, Gavin, what's your view on this? Where can the pound go? So, the pound, we were sort of chatting yesterday, and you mentioned that it broke a support level. Where can it go?
I've been short in the pound for about 4 weeks now. Let me explain why. Traitor. Yeah, sure. It's not that. It's that there was an end of a rising market signal a few weeks ago at 1.3. Now, I'll talk about this on Thursday, but we had a key support level that a lot of economists were recognising, and we broke that support level last week. Now, we broke it on a very high volume bar on the daily chart, closing on the low. There was no green indicator there. So now I'm monitoring the weekly chart. If this weekly chart goes back up on very low volume in the next 2 weeks, we're going to have another leg down, and it's very tradable. We have been making most of our trades in GBP USD, Euro USD, gold. Those are the three majors, but also the GBP Swiss franc is a great currency pair right now. It is just such a lovely instrument to trade with volume. My colleague Grigory Margolin, who's also a trader and our Chief Technology Officer, has developed a system that fires off these alerts when these big volume bars come in. And when we take a long-term view and you look at a weekly chart of the British pound, for instance, against the USD, and I'm a chart trader, I'm not really interested in the sentiment because there's a lot of noise there. But if I see a downtrend, I draw a channel, I draw a bottom line, and I draw a top line. And on the weekly chart, if you look at the Brexit week, when you go home, look at your chart, look at the volume, mark the bottom of the price bar, project it out, and look at what just happened last week, you will understand where we're going. It's not looking good. I'm sorry, but that's my view.
Zach, I have a feeling that you are a man with strong views on Brexit. How do you think this is all going to go? And what can be the impact on the market? So obviously for sterling, but also for the FTSE and perhaps for other currency crosses too.
Yeah, I think as I said in my talk, the market has underestimated, or is it still underestimating, the prospect of a Corbyn government. I'm not saying he's in the Venezuela League, but he's already said that he's going to, or it was already leaked by the Telegraph, that he's going to nationalise energy companies. He's going to be nationalising a lot of things, and nationalisation is a horror for the stock market. It's a horror for the pound. And the way it's shaping up, you'd have the Brexit Party dividing the Tory vote, even with Boris Johnson, and that would let in a Labour minority government, I would have thought. So that's the situation there. Even if that doesn't happen, you've got a situation where Theresa May's managed to delay Brexit by 3 years, her tenure. There's no real indication that any part of the government here wants to leave, the civil service, etc. So there's going to be a big problem there. If there is a Brexit delivered by Boris Johnson, let's say, that's going to go really against the grain. If there isn't, and it's Corbyn, we've got nationalisation. So I think the pound is really in the firing line, and I think that it's amazing it's remained near its 200-day average. I think it's around $1.29 for so long. It's sort of like dancing either side of it. This situation now is I can't see a positive. The only positive, I suppose, is that the FTSE 100 has so many multinationals and dollar earners, so that is quite well cushioned. So you've got the hedge of going long on the FTSE, and I think going short of the pound.
That's a very interesting view. I would be inclined to agree with you. Yes. So yes, we are living through interesting times. So it sounds like the pound just can't win. Either we get a hard Brexiteer in power, or we'll get Jeremy Corbyn. Either of the two, not good news. So we are living through interesting times, and that makes me think. Interesting times normally, refuge assets tend to do well, but gold seems to be unable to go through the resistance at $1,300. Why is that, Andrew?
Well, I think the best place to start on that is the results of a bust are made in the heights of the boom. When there's money flowing, that's when you fix stuff. When everybody is willing to give up a little bit to fix it. With gold, what we're seeing is a global environment that is just effectively under so much pressure, may it be from Trump's tariffs or the Brexit and trade negotiations or Iran, China, whatever it may be. There's so much uncertainty. But gold isn't breaking above 1,300. We think, according to our owner analysts, We think the core figure for gold should be 1326. Should be the equilibrium point of the market based on the level of uncertainty. It should be much higher than it is. But because of all the uncertainty, there are better places for return. More active trading and the more active trading approach is meaning that the stock markets are returning better, the forex markets are still returning better, and effectively, as a safe haven, it should be shooting up. I know Luke spoke at length about this earlier, and I'm sort of stealing what he said. But the long and short of it, for me at least, would be that for gold to break above 1300, I think we need to see the bond markets begin to behave again. I think that the long-term safe investment strategies that have always underpinned the markets are not functioning due to QE, central bank intervention, etc., etc. And other than pound bonds and US bonds, most bonds major bonds around the world are running either negative yield rates or near zero yield rates. So that safer investment strategy, if you were to spread 20% of your portfolio, you'd really struggle to do that. And I think previously, traders have tried to do that with gold unsuccessfully. So I think it would be my opinion that they've taken a safer investors and people balancing their portfolios have been willing to take a little bit more risk for a little bit more certainty. So we then start talking about the indices and the Dow. I mean, the Dow is making new highs. There aren't, other than the ECB, nobody's pumping in QE. We have normalized interest rates. Something's driving that, and it's got to be capital flow. And I think it's a repositioning away from safer assets, because the safer assets just are not returning enough to call them safe anymore.
But it's interesting you say that, because a couple of months ago there was a lot of talk about the inversion of the yield curve. So the inversion of the yield curve, as you all probably know, it's when the 2-year yield curve actually yields more than the 10-year, and it should be the other way around. So it means that a lot of people are looking to park their money on the very safe, even if longer-lasting asset. This is normally seen as an indicator that there's a recession looming just around the corner. I will ask each of the members of the panel if they believe that this is the case. Should we see the inversion of the yield curve we saw at the end of March as an indication, as an omen that there is a recession around the corner? When I say around the corner, obviously I mean in the next 18 months to 2 years. What do you think, Luke?
Can I just specify, when we talk about recession, we're specifically looking at quarter-on-quarter GDP data, aren't we? So, are you talking for the UK? Or?
Well, I was talking about the Treasury yield curve. So, in the US, it's seen as an indication there's a recession around the corner, and we all know that when the US economy sneezes, the rest of the world catches a cold.
Yeah.
So,
wow, that is one question. I think most people sitting in the audience today would agree that the dollar's been overvalued for a very long time. A recession could be a bit of a strong word. I think a retracement is more than on the cards, but to go back to the area that we were in is a very scary place, even for a trader. So I would like to think no, but there's too many underlying factors in the market that could suggest that there is a probability for it.
Gavin?
Well, I have to say, talking to all my friends in America, they're incredibly bullish. And I'm talking about the traders on the street, Wall Street, CME, New York Stock Exchange. They love Trump. They believe he's going to get in again. I think that whether that's true or not, I can see from some of the companies in America that I think what's happened to Boeing is a typical example of a stock that's had a problem, but the underlying company's solid, so they've marked the price down. There was shorts all the way down 3 or 4 weeks ago when the news came out, but now I've seen some volume. But the sentiment in America is actually very different from here. They don't talk about Brexit in America. They think it's a breakfast dish, Brexit, because they don't care. And as you mentioned earlier, the US market leads. And whether we like it or not, it's a very strong economy out there. And there's a lot of people in work. When I was over there, it was record unemployment, and it's turned. Look at this country, right? Apparently more women are employed now than ever in history. So we don't have an employment issue. You'd think we are in the Great Depression, but the reason the reason we're so down, I'm not, because there's a lot of money to be made here, is all you're hearing on the TV and on the media is the same old story. And the uncertainty that this Brexit is causing is actually a great thing for traders and investors, because it's causing volatility. The VIX over the last 6 months has been at all-time highs, and if you don't know what the VIX is, it's the volatility index that measures market volatility in the US. So my personal view is we can talk ourselves into a recession. Countries do it. America isn't. As Donald Trump keeps telling us, America's great again. Well, if you look at the economy, if you look at the stock market, if you look at the numbers, it's a hell of a lot stronger than it was 10 years ago. I still think we're in a bull market and I see no change. But the minute I see on a weekly chart, euphoria, remember we talked about that, massive markup on volume, a narrow spread, everyone's buying now, then we've got a recession coming.
Okay, so famous last words, this time is different. We had the inversion of the yield curve. This time it's not an indication of a recession. Zach, what do you think?
Yeah, I was hoping you'd come up with this yield curve. I regard it as baloney. I think since it's baloney in terms of predicting the market, because no fundamentals predict the market in any meaningful way, which was my discussion. Since QE and since the new command economy that we have in the West started in 2008, I think we've actually got economies in the West which are as controlled as the Chinese one is, which obviously that gets rid of democracy as well, which we also have. We're getting all that. Since, I mean, we had the East-West split before. We had the Soviet Union and you had the West, and we've actually since the 90s just met them halfway. But we do have, I think, many features of a command economy. Bank of England never raises rates, whatever the excuse. It's just made up its mind. Rates are going to be at zero or near zero, and that's it. So the controlled economy means that metrics such as unemployment data or the yield curve or all the things that we used to use before, all the relationships are meaningless. And that's why I like technical so much now, because that tells you, at least you have some truth in a chart. As far as gold is concerned, that's been pegged to the dollar at 1,200 for the last 10 years as well. That was one of the casualties. It's a dead market, it's a zombie market. Gold is no, there's no store of value, there's no store of anything. It's a flat line at 1,200, and anytime it goes up a bit, presumably friends of the Fed will sell it, and anytime it goes down a bit, then maybe central banks buy it. But that's a completely dead. And that's why cryptos are so useful, because they are doing what gold should be doing, flying around all over the place. Gold should have been by now, rather than 1,200, it should have been 4,000 or 5,000. I mean, if you had interest rates down, it should have been 4,000 or 5,000 right now, easily. Why isn't it there? Because somebody's stopping it going there. And I think that's the kind of thing. Why will there not be a recession next year? Because with the yield curve being where it is, because it's a false metric. It's like a clock which is only right twice a day, and that's gone too. So the economy. I mean, the economics is completely being destroyed, and new books need to be written. Maybe someone on the panel will do that, because I don't like writing that. But those relationships are gone, and I think I'm glad I've said that is an important one.
Well, thank you. So, according to Zach, it's all over for the Western liberal democracies. Okay. No, I do see your point, and I think
just like, for instance, Trump could now become president for life, because he's that popular that he would be voted again and again and again. That's what your American friends are in that boat, aren't they?
It's such a divided country, and it is here sometimes, but you do get the feeling that the middle class have seen something in him that they didn't see before, and obviously the healthcare bill prior to that was a disaster. So he's made a lot of promises that he hasn't kept yet, But he said, look, this stock market, this unemployment, it's all Trump. And a lot of people are buying into that. And remember, he's one of those presidents that's not part of the establishment. And that's probably what appeals to many of the middle class. And they feel that he's going to make America great again. And so I believe he will get back in, yes.
And the other point which I think David has said, populism, people vote. Populism has surprised politicians because people don't vote with their wallet. They don't vote on the basis of what is best for them financially. It was best for the UK to stay in the EU financially, but people said, I don't care about the money, I just want to get out. And so, which is the first time in history that people have voted against that. They don't care if their house price goes down. They don't even care whether they lose their job. Yeah. They've got a view of that some things are more important than money, which is quite weird in an ActivTrades trading situation. But I think populism is actually the rejection of money as the most important thing in life, and that's across all generations.
Which is understandable to some extent, at least, because we've seen with the way things are going at the moment. And there was a very interesting book. I'm going to talk about the book as well, so that Gavin doesn't have the monopoly on book recommendations, the Gavin Book Club. So I will talk about a book that's very interesting, that shocked me at the time when I read it, and it was called Capital in the 21st Century. It's by a French economist, Thomas Piketty. And the most interesting fact I got from that was that capital generates 5 times, on average, 5 times more income than work. So the redistribution of wealth after the Second World War, that changed, and there was more equality. And then after the 80s, we sort of went back in time, and now we're seeing very high levels of inequality. And I think people are starting to feel that whatever they do, it doesn't matter. Their lives don't really improve. Real wage growth stagnated. It's the end of the American dream. People no longer feel that the next generation will have a better life than the previous one. And that's why, in my view as well, if I'm allowed to have a view on this, what some people call the populist uprisings are appearing, because people are not happy and they are not thinking about money anymore. They just want to show that they are unhappy about what's going on. So that's a very good point. And but I still haven't asked you, Andrew, and I can see that you want to give your view on the inversion of the yield curve and whether or not it indicates a recession.
Yeah, I really do.
As an economist, I'm sure you will want to talk about that.
Also, I think I'll start with, is there a recession? Or will there be a recession? We are already in a recession. The idea that we are post-2008 and everything has returned to normal is just complete nonsense. Because last time we saw a financial event this bad, it took the Second World War to buy us out of it. And then we still had a mini depression after that. The rise of a superpower was necessary, and I think it was Hoover and the New Deal. It was enormous. Britain spent itself into oblivion. Roosevelt. Yes, sorry, Roosevelt. Britain spent the wealth of an empire. And that stopped the global depression. All of that money, I'm not saying wars are good, don't get me wrong, but that money being put in the pockets of individuals, because if you put an economy on a war footing, everybody works for the state, everybody gets paid. Women went to work for the first time in large numbers as a result of both the First and Second World Wars, but the second especially. Just because we are 10 years on doesn't mean we are out of it. Zach mentioned earlier, and I wanted to come back to this point, about the debt levels. If we were out of this recession, I will consider us out of the 2008 recession when Italy, Greece, Spain, the United Kingdom, Germany, Ireland, and the United States have got balanced bucks and they can control their debt levels. Now, there are many economists these days that will say, you know what, okay, spend as much as you want, it's good for the economy. They're saying that because they haven't got a choice. It's bad theory, and it's certainly bad practice. But the point I would say is that, yes, the yield curve may have worked previously, but we are in a situation that we have never experienced. Keynesian-style spending of pay a man to dig a ditch and then pay another man to fill it in may be great in principle, but the only sort of event that makes you spend every penny you have to fix it is a global war, and I don't think that's a good idea. So it's about growing stage by stage by stage out of it. We've never seen anything like this. And Zach is absolutely right, somebody needs to write a book, because most of the economic methodologies don't work. For our presentations, we looked at bond yields, we looked at all of the normal correlative factors that our traders use, and we basically talked to our traders and they said, well, that doesn't work anymore, that doesn't work anymore, that doesn't work anymore, until we see a period where the central banks no longer have to intervene. The markets, as Zach quite rightly said, will be to some extent controlled. But it's about how we act within those markets. It's about understanding how those markets work, how we react within them, and I will then refer you back to Luke's answer earlier, which is my job to figure out what the hell is going on, his job to make me money.
Fair enough. So, famous last words. This time will be different. There'll be no recession. Okay, guys, I think we've had a good chat. I don't want to keep everybody for too long. Just one last question. So what do you guys think is going to happen today, the final of the FA Cup? Who's going to take it? And how important is that for the economy? Joking, joke.
Being a rugby person, I didn't even realise there was an FA Cup today until Ricardo told me, so...
Wrong answer. Zach, I'm sure you have a view on that.
I'd like Watford to win.
Why?
Because I like the underdog. Yeah, exactly.
Gavin?
0-0. Penalties.
And?
Watford.
I don't care as long as everybody spends lots of money.
Okay, guys. Well, on that note, want to thank my colleagues here at the panel. Thank you very much, guys. Really appreciate it. Thanks for waiting around. To everybody else here in the room, once again, thank you so much for showing up. Really appreciated having you around. I hope you found it useful. After we're done here, we will have an opportunity to chit-chat upstairs, to network, to have a drink as well. And it's not just coffee. There'll be other things too. Yes, please do join us, and once again, thank you very much for your participation today.